pattern in the market is not found in the lines, indicators, or signals that traders obsess over. It exists long before a candle forms, long before a trend begins, and long before a breakout appears on the chart. This pattern is rooted in human behavior, unchanged for centuries, unaffected by technology, and immune to the endless stream of new trading tools. The market is nothing more than a living reflection of the emotional rhythms of the crowd, and these rhythms never stop repeating themselves. Fear, greed, hope, hesitation, panic, regret, these emotions drive price movement with far more force than any mathematical formula ever will. Traders like to believe they are rational, disciplined, and unbiased, but the truth is that the average trader reacts to the market the same way people have reacted for generations. When prices rise, hope becomes confidence, and confidence turns into greed. When prices fall, denial becomes fear, and fear becomes panic. This sequence plays out in every market, every time frame, and every asset class. Because human emotion is constant, the market becomes predictable. Not predictable in terms of exact price levels or exact timing, but predictable in the sense that human reactions form the same waves over and over again. A sharp rally invites late buyers who fear missing out. A sudden drop triggers selling from those who cannot tolerate uncertainty. A sideways market creates frustration, impatience, and eventually poor decision-making. These emotional loops are the true patterns behind all chart formations. Every breakout is created by a group of people finally surrendering to hope and fear of missing out. Every breakdown is created by a group suddenly panicking after ignoring warning signs for too long. Every trend continues because the crowd reinforces it with their excitement or their fear of being wrong. Prices do not move because of magic, they move because human beings push them through waves of emotion. Even professional traders are not immune. Many of them disguise emotional decisions as strategic adjustments, but the underlying cause is the same. A trader who has lost money becomes cautious at the wrong moment. A trader who has just made money becomes bold at the wrong moment. These are emotional reactions dressed up as analysis. The key is understanding that the market is not moved by numbers, it is moved by psychological pressure. When the crowd believes that the market can only go in one direction, the market usually turns the other way, not because of manipulation, but because once the emotional fuel is exhausted, there is no one left to push price further. When markets look most attractive to beginners, they are often already near exhaustion. When markets look terrifying to the inexperienced, they are often beginning to bottom out. This emotional pattern repeats year after year. It repeated in the booms and crashes of the past. It repeats in modern markets dominated by algorithms. It will repeat in the future no matter how technology evolves. Algorithms may execute trades faster, but the decisions behind them still originate from human intention, fear, and greed. Understanding this emotional cycle gives a trader a tremendous advantage. Rather than reacting to price movements, the trader begins to anticipate the emotional state of the crowd. Instead of being pulled into hype, they observe it calmly. Instead of joining panic, they analyze it. The market stops being a battlefield and becomes a story, one that has been told many times before and will be told again. Recognizing the emotional nature of the market allows a trader to see what others cannot. It reveals where opportunities lie, where risks hide, and where the crowd is about to repeat the same mistakes it always makes. When a trader learns to read human behavior instead of chart patterns, the market becomes less chaotic and more understandable. The secret is not predicting price, the secret is predicting how people will react. The trader who consistently succeeds is the one who learns to separate from the crowd, observe its behavior from a distance, and act at moments when most people are blinded by their own emotions. This ability to think differently is not about stubbornness or arrogance, it is about understanding that the crowd, as a collective force, follows emotional impulses rather than rational thought. When the majority of traders react to fear, greed, or hope, they create predictable outcomes that a calm and independent mind can exploit. Standing apart does not mean trading against the trend blindly, it means watching the emotional buildup within the trend and identifying when the crowd has gone too far in either direction. Most traders follow the market because they feel safer in numbers. When prices rise sharply, they assume it's a sign of strength. When prices fall, they assume the worst is yet to come. Their decisions are based on the comfort of agreement. But markets punish those who move with the crowd at extremes. When everyone shares the same belief, that belief is already priced in. The winning trader understands this and waits for those moments of consensus, not to join them, but to prepare for the turn that usually follows. Thinking opposite the crowd does not mean being a contrarian for the sake of it. It means learning to recognize when the emotional balance shifts. For example, when a market surges and traders begin to convince themselves that it will rise forever, this enthusiasm reaches a point where it becomes unsustainable. At that very moment, the independent trader senses weakness rather than strength. When a market falls and panic spreads through every corner, the crowd sees danger, but the independent trader looks for signs of exhaustion. This shift in perception allows the independent thinker to act at moments when others freeze or make desperate decisions. The trader who succeeds consistently does not get swept up by the thrill of profits or the pain of losses. He watches the crowd experience those emotions instead. When everyone else rushes to buy because the price is climbing, he asks whether the buying pressure is driven by logic or excitement. When others panicfully sell because the price is collapsing, he studies whether the selling pressure has reached the point of emotional overload. In this way, the independent trader moves before the crowd realizes what is happening. By the time the majority reacts, the opportunity has already shifted. This mindset requires immense discipline. It is not natural to resist the comfort of agreement. Humans are social by nature, and the market amplifies this instinct through charts, news, indicators, and opinions that invite traders to move together. The independent trader must learn to view these signals with distance. He listens to the noise but is not controlled by it. He sees the crowd entering a frenzy but does not join the frenzy. He hears the panic but does not absorb it. This emotional independence is far more valuable than any technical skill. The ability to act before the crowd is also rooted in patience. Most traders want constant action. They jump in and out because they fear missing out. The winning trader waits. He waits for the crowd to reach an emotional extreme. He waits for the moment when everyone finally agrees on one direction, because agreement is the beginning of reversal. When he acts, he does so with clarity, not impulse. The crowd acts in reaction, the independent trader acts in anticipation. By standing apart, the trader gains a broader view. He can see the buildup of pressure and the release of pressure. He can sense when fear is reaching its peak or when greed is fueling an unsustainable surge. His decisions are based on watching human behavior unfold, not on being part of it. While others try to guess the market's next move, he focuses on understanding the crowd's emotional state. And because the crowd repeats the same emotional cycle again